Good afternoon, and thank you for joining us for today's webinar, Secrets the Banker Knows But Seldom Shares. My name is Gary Dehart, and I am the publisher of Insightful Accountant and host of today's webinar. Our speaker today is Mike Milan. Went through a lot of training to pronounce that properly. Or also, you may know him as Cashflow Mike. He is the VP of Partnerships for Truly Financial. Mike offers expertise in strategic planning, finance, and sales, which he's gained over the 20 years of diverse professional experience that he's had. And in that time, he's developed 13 startups into well-established businesses and earned his nickname, Cashflow Mike. We do a few household items housekeeping items I want to cover real quickly before I turn it over to Mike. And one, this is a CPE eligible session. Like all CPE eligible sessions, you must be present for 50 minutes, 50 minutes, and you must participate in at least 3 of the poll questions. We have 4, you can miss 1, but you must be present 50 minutes and you must participate in 3 of those polls. And those who meet those minimum criteria will receive your certificate within 24 hours. Probably, actually, you'll get it tonight. I think I'm going to be working on it as soon as we finish this up. And then if you have any questions, we do ask you to put them in the chat or in the questions panel. We'll be monitoring those. If Mike cannot answer those live, we'll try to get to them at the end. If not, we'll get to you, or he'll follow up with you afterwards. The link to this recording of this event will be sent to you, and you can also find it on our YouTube channel. And it will be on the YouTube channel within a few days. And the email that's sent to you will also have the slides from today's webinar, where we'll have it posted in a box folder. That covers our main housekeeping items. Again, so if you have any questions, put them in the chat or in the poll or in the, questions and answer pane. Otherwise, Mike will be talking to you. All right, thanks, Mike. Appreciate it.
All right, buddy. Hey, it's Mike Milan, Cashflow Mike to you. And one of my favorite parts of a webinar is the housekeeping, because it has rules. And anybody that knows me, I was a state trooper, my first job, 7 years in St. Louis. So I'm a guy who likes rules, right? So I like following the rules. I like having the rules. So thanks, Gary. Thanks for the opportunity. And today we're going to be talking about one of my favorite subjects, right? One of my favorite subjects is about banking and small business, about putting cash back in your business, about understanding that triangle of language that happens all around you as a small business owner, you as a client, or you as an accountant professional with clients, because what you know as an accountant and what the banker does as a banker and what the small business owner knows sometimes doesn't match. And what I've narrowed it down to is that there's secrets that the banker knows that he doesn't tell you. So because I've done this, right, over the last, 15, 20 years, I've built fintech software tools like the old Finagraph dashboard, like Cashflow tool, like a lot of the other things that Finagraph has done, plus Path by Simplex, all financial analysis. Now I'm working with a digital bank, Truly Financial. And let me tell you about them. One of the reasons why I'm with them is that A, they're sponsoring this webinar, but B, they truly are committed to being the everyday bank for small businesses globally. And what that means is they're solving some of the big problems that I had as a small business owner. 13 startups. I know you've seen these problems. One is I don't get treated as well as the big businesses if my average daily balance isn't that high. 2, I always get hit with all kinds of fees. I always pay seems like the highest rates for everything. And then 3, there was no real spend management systems. I always have to add things onto my bank account to make payments, to do spend management. All those things go away. Truly is an all-in-one banking platform that allows you, or that gives you cash back on every purchase, even using your own money out of your own checking account. They give you cash back. They eliminate the fees, the ACH, the wire fees, or minimize them wherever they can of fees. So you getting a free account, you can get free transactions, even if it's cross-border. Then 3, spend management and payments already built in. I don't need to add Divvy. I don't need to add Bill.com. I don't need to add Melio, any of these other ones. It's already built in. So all in one. So that's Truly Financial. And what I'm going to do is I'll kind of weave them in a little bit when they match, right? When they match some of the things that we're talking about, I'll talk about how Truly Financial is actually helping alleviate some of the problems that banks have with us. So that again is truly everyday local and international banking for SMBs. So here's the thing, right? Here's the thing. I've noticed over the last, 15 years, and I taught at the Graduate School of Banking at LSU, at Colorado, and at the University of Washington. I taught small business banking to bankers who wanted to know how to work with me, right, with that small business owners. And what, outside of the problems I just described to you, I learned their side. I learned what they get mad at. I learned what their biggest problems were with working with me. I'm like going, oh, now that I know that, I can help fix it. I can help, tell people what the problem is, and maybe we can become better customers for the bank, and B, they can be better bankers for the small business owner with the accountant involved. But here are some interesting things, right? For banking obstacles for the small businesses is the way I see it. And I mean, put it in chat. If you got some other things, you've got some other insights, put in chat. But it says that they use more than 5 financial institutions for banking and card payments. And what I found out is that the average small business owner uses 15 banking products. Yeah, think about that, 15, right? They lose up to 2 to 5% of their revenue every time they do an international payment, because there's currency exchange fees, there's wire transfer fees, there's all these things, plus the time involved, sometimes up to 2 weeks. So there's a lot of revenue loss in just doing an international payment. They struggle to compete with large companies because they're taking the hit. They're taking the hit not only just on revenue, they get beat on rates, they get beat on perks. Everything that a large company can get, they don't get. And then it's just not easy, right? It's not easy being a small business and trying to do something internationally. And a cool stat that I read about a month ago, right before Scaling New Heights, 87% of small business owners today have done some form of international transaction. I don't care if it's with Fiverr, where you hire a contractor in Pakistan, or otherwise, they've done some form of international transaction. So 87% was kind of an interesting statistic. And I want you to push back on that, because I didn't believe it at first. So that's the one reason I like Truly, is that it does remove those obstacles, the things that we just talked about. It puts everything in one package, eliminates the fees, and pays you perks. So today what we're going to learn about is, what are the 4 things that bankers complain about me? And the thing is that because they complain about it, they keep secrets. They don't really talk to you about why they complain. So we don't know exactly what they're looking for. But now that I know their complaints, I also know what their secrets are that they hold back from us and why they complain. If they just tell us what they were talking about or what they wanted in the first place, they wouldn't have some of the complaints. I'm also going to talk about a little bit about debt and debt structure. A lot of small business owners, and maybe you're out there, don't understand how debt should be structured. We just kind of put together a hodgepodge quilt of lending products, from notes payable to lines of credit to credit cards to term loans. We don't understand how to use that stuff properly. So maybe if you knew a little bit about how to structure debt and how it works in your business, you'd be a little bit better banking client. Then we're going to look at the speed of cash, right? The speed of cash is the cash conversion cycle. How to calculate how much a company has versus how much they need based on how money moves through their company. So it's going to be a little bit of math, put on there but you need it on how to calculate how much money your company needs, because if there's a shortage, you're also going to learn how much to ask for in line of credit, right? To cover that gap. And it's called the financial gap. And then, of course, you're going to discover and hear some about what Truly does with their small business banking product that can help you with some of these things. All right, so Gary, we're ready for polling question number 1. We've got 4 polling questions as part of the CPE, and I'm going to let Gary launch those. We got 4 of them throughout. So there's your first one. We're talking about loyalty. What is a reason that you would switch banks? We're talking about loyalty. So what's a reason you would switch banks? And we've got the 5 choices there. So if you can put those in, if you use other as one, can you put it in chat? What is the other? And just so we kind of know what that is. And we'll give it, however long is, necessary, or what you think is reasonable, Gary. And
And we'll wrap it up in about 5 more seconds. And if you need the CPE, you will want to participate. Go ahead and wrap it up here in 3, 2, and 1. Back to you.
All right, great. All right. So I put that one in there. That first polling question I put in there because here's where we get into the complaints. So talking about loyalty, and I've grouped them into categories from loyalty, liquidity, timeliness, and preparation. So what I mean by that is, first of all, bankers don't think you're loyal. Remember the stat I just told you that on average, the small business owner uses 15 banking products. Who doesn't believe that? Who doesn't believe that? Anybody? If you want to throw it in chat, that you don't believe it. But then I'll do this, because I've said this at the banking school, and I say, the average that any person uses is 1.8. Believe it or not, 1.8 products for any given financial institution. And they don't believe me, especially if they work for like US Bank or First National Bank or any of these big banks. They go, there's no way that the national average is 1.8. And I said, well, think about it. First of all, just look in your own wallet. How many different banks do you have just in your own wallet? You might have an American Express, you might have, your credit cards from one bank, your debit cards from another. You might just have 3 or 4 banks just in your wallet right now while I'm talking to you. You might think that you're loyal to the bank. You're really not. The other thing is that when you consider mortgage, auto loans, IRAs, brokerage accounts, lines of credit, credit cards, savings, those type of things, 15 products adds up real fast. And a lot of times they're spread across several different banks or institutions. So that's where the average is 1.8 and 15 come from. But they don't think you're loyal. The second one is you have very low liquidity. Now, when I talk about liquidity, I hate using words like that, like liquidity, insolvency, and leverage, because most business owners don't know what we're talking about. But when I talk about liquidity, I'm talking about how fast can we convert our assets to cash? That's liquidity. That's what that means. How fast can we convert assets to cash? So it's the speed of cash. And typically what happens is business owners take too much out of the business because they don't realize how much should be in there to begin with. So that's kind of what we're going to be talking about today, is about liquidity, how to understand it, how to calculate it, and how to know how much to keep in. Third, timeliness. We wait until it's too late. The banks can't help you. Nobody can help you if you wait till it's too late. So by looking at these things today, you can see some of the red flags of cash flow problems. You can see some of the red flags that your business is struggling. You already know it. You can feel it. That's the one thing I like about cash flow, is it's something you can feel. Your business just doesn't run smooth. It runs clunky. You're always waiting for a payment to come in to make another payment. These are the things that I like to solve. Those are the problems. I call them levers. I like to pull levers on how to make, your business run a little bit more smooth and like a machine, rather than like a person that's struggling in the back, pulling 25 different levers. I want the machine to know what levers to pull at the time that it needs to be pulled. And then lastly is preparation, right? We don't know how to prepare our client to have a conversation with the bank, right? One of the things I've seen time and time again, people will go into the bank and they'll ask for a loan. And the banker's first question will be, well, how much do you need? And the business owner's answer, believe it or not, is this: well, I don't know, how much you give me. If you're saying that, if you're answering the question of how much you need with how much will you give me, that's the first indication to a banker that you don't know what you're talking about. And believe it or not, one of the 5 C's of credit is character. Is this person somebody that I trust to give a loan to? And they're looking at your business knowledge to understand that. So I use the acronym DUMB, and I've written books about it. Don't be a dumb business owner. And I'm not talking about being unintelligent. I'm talking about you don't understand my business, right? That's what that means. Don't understand my business. So we don't want to be dumb. We want to understand our businesses. So let's do things to help them be more prepared to have a better conversation than how much will you give me? So that's one of the things I like about Truly Financial. By putting everything in one box, They encourage loyalty. So here's how banks, and here's what my suggestion is to anybody out there listening. I learned a life lesson about 5 years ago that I didn't know, and I carry it through to everything now. It isn't just a business lesson. It's something that I carry through on everything that I do, no matter where I'm at in life. And it's about loyalty, but getting people to be loyal, you have to solve a problem with the first contact. Now, the stat out there is that you'll only hear from 3% of the people that have a problem with you. Yeah, right. I can't hear you, but probably some of you just said, well, thank goodness, because I can't deal with the 97% that we that are silent, right? So you're glad it's only limited to 3. But here's where I saw this in action. My grandmother, 97 years old, lives in Orangeville, Illinois. She can walk all around the town. There's 200 people live there. I went with her to the bank. We walked from her house to the bank. It was about 2.5 blocks. And we went in. So when we went in, I could see her looking off to the right. And there was a guy at a desk talking on the phone, like bankers would do, maybe calling a client, maybe dealing with an issue. But she's just staring him down. And he's on the phone. He's busy. She goes up to the counter, does her business, walks out, all the time staring at this guy. Never says hi, never says bye, never says kiss my butt, anything, right? Just ignores him, but is staring him down. We get outside and she says, can you believe that? I said, what? That guy you were staring down? She goes, yeah. She goes, he didn't acknowledge me. He didn't say hi. He didn't wave. He didn't look up from his desk. Nothing. I've been coming to this bank, for 50 years, and he never once acknowledged my presence. And I'm like, going, he was busy. But there was, she had a problem. Just the problem was she didn't feel given enough respect that she thought she deserved. She told me, she told 2 neighbors who were in the yard as we walked back to her house. She told the people that were coming over that night just for dinner. We were having a little barbecue. She told everybody what this guy did. He had no clue that she was doing this. So you only hear from about 3% of the people that have a problem with you. Kind of remember that. But here's the lesson I learned after that. First of all, only 3% of the people talk to me, but how to deal with it was next. Solve a problem with the first contact. And I learned this from Nordstrom's, believe it or not. So Nordstrom's back in 1962 put out a new business model. They got tired of competing on price in downtown Seattle. Everybody could buy a shirt anywhere up and down Main Street. They said, we're tired of it. We got to find a different way to compete. So they developed this graph. It was about how strong a relationship that they had with the customer versus that satisfaction, or how likely somebody was to gripe, right? I call it happiness, but how likely are they to gripe about your service, meaning the 3%. And what they figured out was that the stronger the relationship was, the least likely they were to gripe at you, right? So the stronger the relationship was, the higher it was, the least likely they were to gripe, right? They'd be pretty happy. They wouldn't gripe that much. But the worse the relationship was, the more likely they were to gripe, right? Which means they weren't close to the customer. That's where you hear stories from Nordstrom about taking back tires, right? Any returns that you take to Nordstrom, they'll take it back. A lady took back a set of tires. I'm going to say, I don't know, 10 years ago, might've been 15 years ago now. And they took them back even though they don't sell tires. Why? Because her receipt said that address, and they had just taken over, we'll say, a Sears. I don't know which store they took over in a mall. They took over a Sears. They had a tire shop. She bought tires from Sears. They looked at the address, said, yep, you bought them right here in this store. It's not us, but we'll take them back. They do that with everything at Nordstrom. They do everything to take away your no. They put bars in the aisleways so men have a place to sit. I guess why the women are shopping, because they're always on the floor where the women's clothing is. They put, they'll call you if you don't find what you're looking for. They'll call you out of the blue. They'll deliver it to your house. They'll take away every reason you've got to say no, because they're trying to solve that problem with the first contact. Now, what I learned from that was be timely, be personal, and be effective, which means take care of it with the first contact, have a good relationship with people, make people like you, right? Be a chameleon, kind of talk to them on the level they like to be talked to, and be effective, which means solve the problem. Even if you can't solve the problem, talk them through the reasons why you couldn't. But those types of things there will help encourage your customers have more loyalty with you and your brand. So also, you're talking about all these different products and people jumping from one place to the other. Looking for banks that provide more than one product is something that you can do, right? All of them put out what products that they have, whether it be, corporate cards, whether it be multi-currency accounts, those type of things. Look for the ones that actually reflect your business model, right? Look for the ones that actually reflect your business model, where in this case, truly is the one that actually does the checking, does the ACH wires, does the multi-currency accounts, international payments, all those things. So if that's what you're looking for, look for banks that provide more services so you don't have to have as many banks and you can provide loyalty to one. The other thing to encourage loyalty is that they have better technology. I don't know about you, but two banks that I've worked with that I think have terrible technology. One, believe it or not, is USAA. I've had problems with USAA. They try to use Zelle for their payments or transfer money. It does not work. I'm used to Venmo. I need a company and a bank that has a cleaner way to issue money back and forth, right? A cleaner way to do that, to set up accounts, those type of things. I also, worked with a US bank, right? US bank. And it was just difficult to do different things inside their apps. I always seem to have to go to the bank. I haven't had to do that in a long time, but US Bank at the time, it was always a trip to the bank branch. So better technology is another way to encourage people to using your products. So Gary, how about number 2, right? We just talked about loyalty, and because we asked, why would you switch banks? And we talked about being loyal. So what's the next polling question? Any questions so far from the audience?
We're good right now. And so we're going to throw out, what type of bank do you use for your business? Local, regional, national, online bank, or other?
Yeah, that's an interesting question, right? I mean, some people like the thought of a big bank, and other people like to know the people. But you can have a relationship even with an online bank, even with a digital bank, because people are people, no matter where you go. So that's kind of the way I like to work with a bank, because I like to know the people behind it.
Yeah, and then the quick results here: 54% local, regional, 11% national, 7% online. So there you go.
Yeah. Okay. So that's probably true. The local regional, I mean, everybody likes that. They like their hometown bank. Here's what happened in 2008. There was a massive consolidation, whereas prior to that, there was almost 7,000 banks, and that number is down to around 4,000 now. So what was happening after 2008, and when the bankers burnt the world down, they started consolidating, where if you didn't have $1 billion in assets, you were kind of a target for acquisition. So I can see some of that goes on now, but not as much as it was then. All right, so the next one we talk about loyalty. The next one we'll talk about is liquidity, and we focus definitely on liquidity at Truly Financial, because again, you got smart link accounts to do for spend management. You got low to no transaction fees, keeping more money in your bank. You get cash back on all your purchases, and we focus on the speed of cash, which is the use of your own money versus how much you keep on an average daily balances. Most banks out there try to judge you on how much money you keep in their bank on a daily basis. That's why they put it on your, put it on your statement, as you get more perks when you keep more money in their bank. We don't care what you have on a daily basis. We care that you're using it on a daily basis and making money move through it. So liquidity, let's talk about some basic things that banks look about liquidity. And I always like to throw in the debt to equity ratio. Mainly because when you're a business owner, you've got people that you love and trust, and we call them trusted advisors. And it used to be you needed 3 of them on your team, right? You needed a banker, you needed an accountant, and you needed a lawyer. All those people kind of helped you run your business. Well, again, after 2008, bankers kind of fell off the pedestal, right? They kind of lost trust. People stopped trusting them as much. Now they're still in the top 10. Matter of fact, the results of some surveys I've done over the last 10 years, they rank about 7th or 8th, but always behind other, right? Other always ranks higher. Like people would rather go to the bar and talk to Joe. Hey, Joe, let me talk to you about my business than actually talk to the banker. Right? So it's kind of a weird thing that's happened that I can see. But here's the one thing that you can do as an accounting professional is know this ratio cold, up and down, because this is where two trusted advisors, the accountant and the banker, give the business owner advice, but it's opposite advice, which means one of you is wrong. The thing is, you're both right. You're just not right at the same time, right? It depends on the situation with the business owner and what they want to do next, like next year. Let me explain. Most bankers' goal is to give you a loan, right? That's how they make money. So they want to give you a loan. And in order to do that, they want to increase your total liabilities. But they lend against equity. And I think everybody on this call knows that equity is actually net profit that gets put on the balance sheet in the form of retained earnings. That's kind of how you build equity outside of just dumping cash into the company. So net profit gets put onto the balance sheet in the form of retained earnings in the equity section. The thing is, the accountant's main goal is to reduce your taxable income, right? We all have tax strategies and how do I pay less tax and those type of things. Well, when I pay less tax or I have losses year after year after year because of, accounting things that we can do or expenses that we can run back through the business, we also put a lower amount of profit into the equity section, or we reduce equity with losses. So if I'm a banker and I can lend against equity, but the accountant wants you to have less equity, well, there's a problem. It reduces the ability for the banker to be able to lend. So when I say you're right, but never right at the same time, you have to know as the accountant, does my client need a loan? And I'm not talking about today, I'm talking about next year, right? Because they're going to look at the trend of this ratio right here. What does it look like over the last 10 to 12 months? Does it maintain a certain level? And you're like, oh, what should it be? I'm going to give you the answers to the banking test and nobody tells you. Right. So let me explain debt to equity. It's total liabilities divided by total equity. So to kind of put it into perspective, it's like buying a house, right? How much skin do you have in the game? When I buy a house, I have to put some money down. The bank typically wants you to put, 20%, we'll say. I know there's other programs that give 0 down or 5% down or 10% down, but typically they want you to put 20% down. Because the bank puts in 80% of the purchase price. You put in 20, they put in 80. That gives you a 4. Yay, I got a 4, right? But what does that mean? It's like any ratio. It doesn't mean anything unless you compare it to something else. Well, this says for every dollar you put into the house, the bank put in $4, right? So every dollar you put in, you let the bank put in $4. That's kind of how that works. Now, to a bank, this number means risk. And risk would be like, the higher the number, the more risk they have. Think about if you only put 10% in instead of 20%, you put 10. So it would be 90 divided by 20 equals 9, higher risk. You have 10% in, they have 90% in. So it equals 9. For every dollar you have in, they put in 9. That's why there's more risk. Here's the thing about a business. They're not going to lend you $4 on your business for every dollar you put into the company. They're only going to lend you around 2.5, which is $2.50. So if I put $100,000 in, they'll loan me up to $250,000. So $2.50 for every dollar I put in. So that's where we want to look at. We want to be at 2.5 or less in this debt to equity concept if we're looking for a loan. When? Next year, right? It prevents people from dumping a bunch of money in, getting a loan, taking the money back out. This is the trend that they want to see, 2.5 or less. So the next one that we're looking at is timeliness. Do we ask, and were there any questions on that? Kind of went through that a little fast, but 2.5 is the number. I want to make sure that we hammer that home, right? Remember, this is them thinking about you and your skin in the game as a business owner. Because if this gets higher, say it's a 5, it's a 6, it's a 7, the way the banker reads it is, you won't even put money into this business. Why should I? Right? They think that you don't even believe in it. So you could think about it and explain to your customers or clients that this is a measurement of how much you believe in your customer, in your own business. So much so that, yep, you're willing to pay tax and you're willing to keep money into the business to be able to keep it running smoothly and take a loan later. So that's debt to equity. The third complaint that the banker has about us is timeliness. We wait until it's too late, right? And part of that is we don't know when. We don't know when we should be asking these questions or looking at things. So what I like about timeliness is most of it comes down to the fact that we've put ourselves into a death spiral, right? Where we're now selling off our assets to make operational payments, right? To pay for our operating expense. That's kind of the death spiral, because the only reason to buy an asset is to generate revenue and profit. So when I see customers or companies that are selling their assets, they're also reducing their ability to generate revenue and profit, which is the death spiral that they talk about. You know, it's like eating yourself. So how do people get around that, right? They start looking at cash flow a little bit more seriously and understanding that the speed of cash is important. So what they're now doing is they'll bring in a customer, a client, an accountant who will put on several different companies, and transfers between these companies are instantaneous, if not one day, which means money moves between them. We're not waiting 2 weeks to get paid. We're not waiting for 3 days for something to clear and a settlement to happen. Money is moving between these clients and customers fast. So much so, here's what's happening. Yeah, truly, I'm seeing this and I'm so excited about it, because now this same owner, the same business owner, is starting to invite their suppliers and their customers so they can also get paid and pay faster, going not only within their own portfolio of companies, but out into the market. The network effect is starting to take place. So they're getting ahead of the game and increasing the speed of cash as it's coming into their business. So let's talk about that speed of cash. I've said that several times, but what am I talking about? Now, you don't have to memorize these. I've got them on there, but I want you to know that I took off of the balance sheet. This is sample information, balance sheet and income statement that I'm going to use to teach you how to calculate cash conversion cycle for not only a company with inventory, but what to do with it, right? What to do with it, and also a service company. So if you got people that don't have inventory, there's a way to do this as well. So here's kind of the numbers I'm going to use. You can screenshot that. You can do whatever you like, but the numbers are also repeated on the next slides. First thing you got to do is start with, okay, well, how much do I have? It seems natural. Like, well, how much money do I have? If we're going to talk about how much do I need, how much do I have? And the number that the banks use is your working capital, right? How much working capital you have. And it's a pretty simple calculation. You go to the balance sheet and you take your current assets and you subtract your current liability. So in this case, we've got 2 million. We're going to subtract that 1.5 million. We've got $530,000. Yay. But is that enough? We know how much we have, and this is considered positive working capital. You might see that as a zero, and that's considered neutral working capital, or you might see a negative number, which is called negative working capital. Now, let me tell you about those three: positive, neutral, and negative. Positive is the most common and the one that you want, right? It's the most desired. That means you've got cash. You can cover your own daily expenses. Neutral, you're like, oh, that's a weird one. It is a weird one, right? And that's the one that got the car industry in trouble in the 90s. Just as they were practicing just-in-time inventory, they are also trying to practice just-in-time cash flow management, which means as the money came in, they would make payments on everything that they had to make payments. So it was an equal exchange. Well, when you do that, you have a cash poor business, and it just doesn't work. And we had to have a bailout of the auto industry because of this just-in-time process that they did in inventory, but try to do it with everything from salaries to other vendors in the works. So neutral is kind of a weird one, but it is a practice that some companies try. I've never seen a successful one. The last one is negative working capital, which indicates there's a big problem. You're spending a lot more than you're bringing in from a cash flow perspective. But here's the thing, it's not always bad. There are some high growth companies like subscription-based SaaS companies where you'll see a negative working capital position, and it's only there until subscriptions reach the point of a tipping point, right? You've heard the tipping point. That means when revenue and the waterfall effect of subscriptions actually outpace the growth in expenses. It's a cool thing to see, but when you see negative working capital and you see a business model like that, chances are they just need time to build their subscription base. The other thing I want to tell you about, this working capital is that it looks like a lot like, the current ratio, right? Which is also another measurement of, do I have enough money to run my own business? So it's current assets divided by current liabilities, not subtracting, it's dividing. So 2 million divided by 1.5 equals a 1.35, which in all, practicality means that for every dollar you owe, you've got $1.35 to pay for it. Now, when I talk to folks that don't know anything about current assets, current liabilities, I always give them an example. Like, let's imagine that your current asset that I'm talking about is your checking account. And let's imagine that the current liability I'm talking about is your credit card. When you see this number is a 1.35, here's how you should play it in your head. For every dollar I owe on the credit card, I've got $1.35 in checking to pay for it. And when I do that, business owners tend to start to get it. Now, what should that be? Well, that should be a 2, right? In most cases, if you do a rule of thumb, your current ratio should be a 2. That should be your goal, right? Now, you can always compare yourself to the industry average, but a good rule of thumb is that number should be a 2 when you see that. So what do I do next? I know how much I have. I've got $530,000, but I don't even know if that's enough. Now I have to calculate up the financial gap. And when you think of a gap, do you think you want a large gap or a small gap? Well, generally you want a smaller gap, right? So that's what we're going to be looking at is, how do I create a gap that's small? And when I talk about the financial gap, I'm talking about the amount of time that your company doesn't have enough money. This is where a company feels clunky. If the gap gets too large, it feels like you're always trying to balance money coming in versus money going out. The smaller the gap, the less money it takes to run your business. Let me repeat that. The smaller the gap. So when we do this calculation, the smaller the number, the less money you need. And that's a good thing, right? So in this case, this is a company with, with inventory. Maybe they're selling, to a retail shops or Walmart, or who knows, but they've got $1 million in inventory. They do about $5 million in cost of goods sold. They're owed about $645,000. They owe $750,000, and they're doing about $7 million in sales. That's the kind of scenario we're talking about. Well, what you do is you create, and I put it in this format so people can, kind of see it happen in action. We got a question. Chat is disabled. Okay. I don't know how to answer that, Gary.
I will look into that. It shouldn't be. Try put anything into the Q&A then if it's disabled.
All right, Q&A is fine too. All right. So when you're looking at this, we got 2 levels. We got money coming in. That's the top level, this top line. And then we overlay that with money going out. That's the bottom line. So think about it this: money coming in versus money going out. That's kind of how we're looking at it. So up top, we got inventory days and the AR, right? Because the typical way something gets bought is this: I have inventory, it sits on the shelf, it sits there for a certain amount of time. Then somebody buys it and I give them an invoice, and the invoice sits on somebody's desk for a certain amount of time. All the meanwhile, I bought the inventory, that invoice sat on my desk for a certain amount of time, and then I paid it. The difference between me waiting for a customer's money and me paying the money to my vendors is called the financial gap. The actual calculation is inventory days plus AR days minus AP days equals the financial gap, the cash gap days, right? So let's kind of go through that. In this case, I'm going to do the actual calculations, which is converting these to how many days they are. In this case, it's inventory divided by cost of goods sold times 365 equals 90. So 90 days of inventory. Then we also have 34 days of AR, which is, well, there's our dyslexic guy, 645 divided by 7 million times 365 equals 34. And then we got the AP days, payments made, AP days of 750. I owe that. And my cost of goods sold for the inventory that I bought is almost 5 million times 365 equals 56 days. So then when I put those three numbers together, 90, 34, 56, I get 68. So 90 plus 34 minus 56 equals 68. That means that's the amount of time where I don't have enough money to cover the day-to-day activities of my business. That's why things feel clunky. I'm waiting too long for money to come in, right? Versus how long I'm paying. So 68 days. We use that in the next calculation of how much do I need, right? I have to determine the gap before I can determine how much I need. So we take the working capital and we're going to subtract how much we need, right? And in this case, it's $916,000. And you're going, what? How did you get that, Mike? Well, let me explain. We're going to talk about, because this is an inventory-based company, we're going to talk about inventory. So when I look at cost of goods sold, I've got $5 million, right? So 4.9, I'm going to divide that by 365 to come up with an average amount that I spend per day, right? So I spend $13,000 per day just to run my business. That's kind of how my business runs, $13,000 a day on average. Then I'm going to take $13,000 a day and multiply that by 68 days because I have to still keep buying inventory to be able to sell it. So I need enough inventory to cover that gap, 68 days. So I need $916,000. The thing is, I already have 530. So I don't need 916. I actually have a cash shortage of 368. 530 minus the 916 equals 386,000. I said 68. See, I'm dyslexic today, like crazy. All right, so 386. That's the number that's important. That's the one that you're short. That's the amount of money that you need to get either through a cash infusion or you need to have more money coming in somehow. And I'm going to explain a way you might be able to do that. Or you need to ask for a line of credit. Instead of going in and saying, how much will you give me? Your now new conversation sounds like this. Hey, I need a line of credit. The banker will say, okay, how much do you need? I say, I need 400,000 because usually these things are given out in round numbers, 400, 500, 450, those type of things. So because I'm at 386, I ask for 400,000. All right. And important to properly categorizing cost and cost of goods sold. What about expenses and payroll not in? Okay, so I'm using cost of goods sold for this company. It's okay if you want to wrap in all cost, right? Both of those. I'm using it just as cost of goods sold for this company because it was a straightforward, I'm buying inventory and selling it. You can also use AP, right? Anything that you put in AP can be used in this type of thing. Payroll, if I'm in a service company, I'm going to use the payroll number as my number to calculate my need, right? So, and I'll explain that. Okay, so I'm going to say, hey, I need $400,000. And my conversation with the banker is not going to sound like this. Hey, I've got working capital of about 530,000. I've got 90 days worth of inventory. I'm getting paid in 34 days. I'm paying my bills in 56 days. And based on that, I've got a financial gap of around 68 days that I've got to cover. I've already bought this much inventory. So I'm at $5 million in cost of goods sold based on last year. So I'm spending $13,000 a day. And I think that my cash shortage at this point in time is 386. So I'm asking for 400,000. And guess what? He's going to say yes, because he's going to do the exact same calculation. That's the exact same way I've taught it at 3 different graduate schools in the country to almost 4,000 bankers nationwide. This is the formula they use to calculate how much you need on your line of credit. So I told you about what if, right? We've got levers. I got 3 levers I can pull. I've got AR, I got inventory, I got AP, 3 levers I can pull. So I'm like going, before I go ask for a loan, what if I just run my business a little differently? Now, in this case, I don't think I can get paid faster than 34 days. That's pretty good. I don't think I should pay slower than 56 days. That's pretty slow, right? And I don't want to start, getting people mad at me. But what if I reduce inventory down to 60 days? I just reduce it by 30 days, right? First of all, the calculation I did was to back that into how much should I have in inventory if I only want 30 days worth? I had $1.2 million for 90 days. If I want 60 days worth of inventory, I need 800,000 on the shelf. And that's the calculation. 808 divided by 5 million times 365 equals 60. Keeping AR days the same, keeping AP days the same. The new calculation is 38 days. This is the visual proof that tells you that if the gap is smaller, you need less money to run your business. All we did was reduce inventory. Now, some people will say, how does reducing inventory put more cash into the company? Super simple. What we normally do when we sell something is we reorder. Oh, I sold 5 of that, reorder 5. What if I only reordered 1? Then I keep the money that I would have spent on the inventory that went out the door in my pocket. And I only buy the inventory if I need it, right? And I've got a whole inventory calculation worksheet on cashflowmike.com and the free resources that teaches you how to determine how much you should have in each given product, all your SKUs. So it's kind of cool. So if I reduced inventory, my new calculation is this. Got 530,000 still, but now I need not 916,000. I only need 512,000. Here's how. Remember we still are spending $13,000 a day. I just have less inventory, so I'm buying it less often. So I only need to cover 38 gap days. So I only need 512. So all we did was reduce the amount of inventory, which puts more cash back into the company. And when I take my $13,000 a day that I normally spend and apply it towards 38 gap days, I only need $512 to run the business. So I no longer have the cash shortage of 386. I actually have no cash shortage. I have enough, and this business should run smooth at this point in time. So Gary, how about number 3? Buddy, we're cranking right along. How about number 3? Any questions so far on what we covered? We're kind of math always goes through pretty fast, but we'll go over the next polling question is, have you ever or do you ever recommend banks to your client or a bank to your client? Yes or no? Should be pretty simple.
Yeah, we'll close this up in about 3 more seconds, and then we'll move along, and I'll share the results with you. Here we go, closing it up.
Oh, wow. That's closer than I thought. Closer than I thought.
All right.
Okay. All right. So how's this different for a service business? We don't have inventory, Mike, so we're not going to use that. But if you look at it, it's still kind of similar. We still have an AR day, right? We still got an AR day. You said the current ratio should be 2 and 2 or lower, or 2 and higher. Okay. Yeah. The current ratio should be 2 or higher, which means for every dollar you owe, we'll say on the credit card, you have $2 or more to pay for it. 2 or more. Good one, Julie. Thanks. So back to the service company. How's it differ? Well, you don't have inventory, but you kind of do. You've got an inventory of hours, things that you have to pay for your employees. So instead of AP, like cost of goods sold or operating expense, stuff like that, most commonly, you're going to use the amount of payroll, right? So in my hotel staffing business, I would get paid on average about 45 days. But during that time, if I paid every other week, I would have to cover 3 payroll periods in 45 days. If that's the case, and my average amount of money that I was paying in payroll was $100,000, that means my cash need is a lot easier to calculate than on inventory. is only $300,000, right? My cash need for a service company is only $300,000. You still take your AR and you say, how many payrolls do I have to cover in my AR period? Now, some banks kind of take a shortcut here. If you're looking for a line of credit, and they will ask, or they will set your line of credit rate at 1.5 times your operating expense. Some people will do that. I like to use the payroll because I never want to leave payroll short. All right. So that's kind of it. So remember, there was a cash need of 300,000. In this company, if this was a service company, they have working capital of 530. They only need 300. They should be good to go to cover their biggest expense, which is payroll. All right, last one, being prepared, being prepared to have the conversation. First of all, those two calculations, that puts you in good position to talk the language to the banker and be prepared to have a good conversation with them. And that's really what banks want, is they want you to know your numbers, right? Know what's going on in your own business and be able to speak it back to them. So let me get to the debt structure real quick. Let me get the debt structure. And we've got about 9 minutes, but I'm gonna tell you this. If you look at we'll say a beer distributorship, if you look at that and put it in your mind, it helps you understand how to structure debt better. And I always like to tell things in stories because it helps you understand the concept better. But if you go into a beer distributorship, you see stuff, right? You see a building, you see trucks, you see forklifts, you see shelves, shelves on it. But what you're seeing, office furniture is the gross fixed assets, right? So if you're not going to use cash, how do I pay for gross fixed assets? Well, real easy. You use a term loan, right? So if you're not going to use cash, use a term loan. And here's the rule. The length of the loan should match the life of the asset. If you can depreciate something for 5 years, you get a 5-year term loan. That way, when depreciation ends, so do your payments, right? So as the benefit ends, so do your payments. That's how to do that the best way. Now, where does the money come from? When the bank looks at your business, they're going to look at a specific place for each one of these on where's the money going to come from to make the payment. And in this case, they look at your retained earnings or your net profit, right? That's one of the biggest things. Does this company have enough profit or retained earnings to be able to make this payment? That's what they're looking for there. So that's the first level of it. Now, the other thing you'll see on these shelves is inventory. And so the beer distributor takes inventory and they put it over at the convenience store or grocery stores or things like that. But if you've ever been in there, in the section where the cooler where the beer is, every spot's filled, right? Every spot's filled. It's neatly faced, front to back. They pretty much have it. That's called their base level inventory. That means the amount that they sell any given week, they want to have exactly the right amount that they don't run out, but they don't have too much, right? It's called base level or par. Some people use the words par. So some other people will use like permanent working capital. And we'll say like in one of my bars that I had, I would have 20 cases of Budweiser that I knew that if I had 20 cases, I would never I'd never run out, but I wouldn't have way too much. It was around the right amount. And it's usually how much you're going to, sell that week plus a safety amount. And my safety amount was like 2 extra cases. So I'd probably on average sell 18. And I'd get 2 more just for safety. So 20 a week is what I would have right on hand. So that's the base level. And if you do this right, you'll only ever have to buy your inventory one time, right? And sometimes with this, you can get an SBA loan for the inventory and you'll make your inventory payment. Other than that, your customers will be paying for the replacements, right? So let me explain that. So what I said was you can pay for it one time. Normally, you would buy your base or working capital or permanent working capital or inventory with a term loan. It's usually 5 to 7 year term loan is what you're going to use, 5 or 7 years. We already know that you pay with term loans from retained earnings, right? Or net profit. The other part is that when people buy it, people come in, they buy, you take a 6-pack of Budweiser off the shelf. What you're supposed to do then is the next case of Budweiser or 6-pack of Budweiser you put back on the shelf is you're going to get a vendor's invoice because they gave you a new case to put back, right? To replace the one you just sold. You're going to use the customer's money to pay that invoice. So the money you just collected on the sale, you take that money and first pay the vendor's invoice. And then the rest of it goes into your operating account to run the rest of your business. But the cash conversion, it pays for the replacement. That way, I said, if you do this right, you'll have a one loan, one time, you'll buy your permanent or base level inventory. The rest of the time, you're using the customer's money to replace it. Now, here's what happened. Super Bowl comes around, St. Patrick's Day comes around, 4th of July comes around, and you got all these spikes where I don't need 10 units anymore. I need more. Maybe I need 10 more because it's a Super Bowl, it's 4th of July, it's any of these things. This is where you'll see the seasonality start to cut in. And what this is used to pay for those 10 additional units, because I had the 20 already, it's my base level. I added 10 more during Super Bowl or any of those other holidays. That is your seasonal working capital, right? So it's used to cover the extra high seasons. And you use to pay for these periods your line of credit. That's when you dip into your line of credit and you buy the 10 extra units. How do you pay for your line of credit? Real simple. It's the cash conversion, which means as your customers pay you, you immediately pay off your line of credit, right? That's what you're doing. You're paying off your line of credit because you want to keep this down. You don't want to carry a balance on it. A, you got to pay interest on it, but B, there's a such rule after Dodd-Frank called you have to let it rest, which means the balance goes to zero and you don't draw on it for 30 days once a year. If you got into trouble, if your people are into trouble now, you can still get into this debt structure. You can take your line of credit and ask your banker to term it out. That doesn't mean end it. That means convert it from the line of credit that it is, convert the debt to a term loan, right? That means you now have a term loan that acts like your base level or permanent working capital loan, and you can get back into the flow right after that. The thing is, that's kind of a one-time get out of jail free card. After that, they don't think you know what you're doing with debt, and they probably won't give you a line of credit back, and they may end it or terminate the line thereafter. So you can always try to do that. If you want to go into this more deeply, just contact me at mike@trulyfinancial.com and we can talk through this. About the last polling question, and we'll kind of finish it up, Gary. So here's the last one. Would you be interested to learn more about Truly Financial and how we put money back into your business?
Nobody saw that one coming.
Yeah, nobody saw that. Oh, yeah, we kind of have it is a sponsored webinar, right? It is a sponsored webinar. So
yes,
you got to pay the bills around here.
Exactly. So one question before we cut everybody loose. So in your book, actually in both your books, and we talked about this before, but I want you to touch on using percentage, and you and I quote, kind of argued about it, not really, but using percentages versus dollars, or dollars versus percentages when dealing and speaking with a client. And I'm on your side. I agree with you, but at first I'm like, no, but kind of just touch base on that, because I think after kind of thinking through it, I think it does make sense.
All right. So if you don't know what Gary's talking about, is there a handout for this? And we can give him the slides if you want to, Gary. Either one, I can do that. You want me to send?
If you have them, that'd be great.
If you'd like them though, I can give them to Gary, or email me at mike@trulyfinancial.com and I'll send you out the slides.
Yeah, send it to me, and then I'll put a link to it as well in the email that goes out. So
no worries. All right. So what Gary's talking about is I've got a thought that says stop using percentages with your clients. Right? Only speak to them in dollars. So convert these percentages to dollars. Not because it's not interesting to know, hey, maybe my sales increased 7%, or we're up 31% in this, that, or the other. But what I've noticed is that we're causing people to have to do that extra step of math into their head, right? Which is 31%. Was that $3 or is that $300,000, right? How much is the difference? And what I like to say is, well, just ask them how much in percent a gallon of milk cost. And if they can't tell you, they're probably going to say it's in, $4, right? So I like to talk dollars because we instantly know the gravity of it, right? We are the magnitude of change. I'm up 300,000. I'm up 200,000. This cost me $50,000 more. When I'm doing that, I'm talking about, how to prioritize decisions and how much of a magnitude of change is. That way it gets your attention right off the bat. 31% doesn't get my attention like 300,000 does. That's all.
There you go. All right. I certainly appreciate you taking some time, everybody who attended, but certainly, Mike, appreciate you sharing your knowledge. It's a wealth of knowledge that you certainly have. I'd love to have you back out here and continue that discussion. Certainly give one more time your email address if people want to reach out to you directly.
Yeah, they can reach out directly, Mike@trulyfinancial.com. You can also follow me on any of the social handles at Cashflow Mike. I've got a website at Cashflow Mike. Truly's got all their stuff at Bank on Truly. So if you're looking for Truly Financial, their stuff is on Bank on Truly at any of the large social media companies.
Very good. And then are you heading to any shows coming up?
We are in discussion of playing it. I know QuickBooks Connect is on our radar.
Yeah. Person earlier told me that the booth space is about double what it used to be.
It's pretty high.
It was not cheap before.
Yeah, they're pretty proud of it. But it's Vegas too. So you got to remember, in Vegas, not only is the cost of the booth up, but then it's all the other things that are attached to it, right? The electricity, all the unions get involved. So there's a lot more cost associated with a booth there.
Oh, yeah. So, all right. Well, maybe we'll see you out there if we don't see you sooner. Thanks, everybody, for joining us, and look for that email and your certificate if you participated. Thanks a lot. Talk to you soon.
Appreciate it. Thank you.